Hello, welcome to this video. In this video, we're going to have a look and see what you need to be looking out for when you come to sign a set of accounts and what those numbers actually mean. It's going to be a really important video for anyone out there who's a little bit unsure as to what all these crazy numbers represent. Well, this video is going to go through and explain that all for you in really simple terms so that you can have confidence that when you sign a set of accounts, you know exactly what you're signing for. My name is Patrick, and we are going to roll the VT straight away and get straight into it. Hello, my name is Patrick. I am a chartered accountant, a certified UK trainer with a fancy new logo, that QuickBooks Chap on the internet, head of accounts here at Boffix, and also your friendly podcaster who goes live each and every Monday morning for Ask the Accountant. Now, in this video, we're going to be talking about the wonderful world of accounts, tax returns, and corporation tax returns, all that sort of stuff. And basically, we want to put you in the situation that if you're about to go sign a set of account, A, what you're signing for, B, what does it mean, and C, should you be signing it? Are you confident in those figures? Well, without further ado, let's go straight into this one because I think there's some real important lessons to learn here. Exactly why you should be figuring out what to sign on your account. Let's have a look. Well, straight away from me, you can see here that I am at my Boffix website. In the top right-hand corner, there is the client portal. I'm going to go over to the client portal because you'll see that under signing request just here, I have a test limited CT document pack ready for me to sign or reject. So I click on the sign option and up pops the accounts. Basically, you've got to go in and sign for our system, sign or reject up here, your name, comment, and press confirm. And that's basically giving authority for then the accountants, in our case ourselves, to go and file it. Let's look at these in a little bit more detail. Before we press the sign button, let's go and have a look at them and just see for a little bit what the information telling us is here. All right, first of all, the front page. Just want to be making sure your start date and end dates are correct because that's the one that's going to be filing for it. So easy for you, someone to maybe have reduced the year end or extended the year end, something like that. So just make sure that that bit's been correctly brought through. The next page, your contents page. This is going to be really useful to understand what to expect as we're going through the statements. Company information is what we're going to look at next. The company information tells you quite a bit of important information. For example, who the directors are, what the registered number is for the business, where the registered office is, and what most people show as well is their accountants there as well. Then finally, if you have available, you have a secretary down here. Realistically, from your point of view, most of this should be picked up on, but it's always worthwhile just making sure that you haven't updated, say, your registered office. That's a really key one that people tend to miss. And just making sure on that, but most of the time that one's going to be absolutely spot on. The next one's really important. This is what's called the director's report. Some key areas here you need to understand. First and foremost, principal activity at the top there. Make sure that that principal activity explains reasonably what that actually relates to. That's going to be really important for you to get confidence of this going forward. Make sure the directors are up to date. And do just have a look at the statement of director's responsibility. At the end of the day, when you sign these accounts, it's you, if you're the director, that is, it's you that's going to be confirming that you agree, that you're happy with the statement. Now, we can't change that or anything, but it's always worthwhile you keeping up to date on exactly what your requirements are. The next one is called the accountant's report. The idea of the accountant report is basically, as the accountant, this is setting out how we've set the accounts up. If we're a practicing member of any institute or anything, you'll see here that we've got Institute of ICAW, and then you should have your accountant's details below. Now, the next one's called your income statement. We're going to gloss over this because actually you get a much more detailed version of the income statement later in the pack, and it's much more beneficial to look at that one. But ultimately, the most important number you're going to see here is what profit or loss you made at this particular year. In most of the time, you'll find that a profit is a positive number and the loss is shown as a negative. How's the profit or loss created? Well, it's created by the turnover, which you'll see at the very top of this statement. And then you'll see all of the different expenses categories there. Cost of sales, which is supposed to be costs of goods that basically relate directly to your turnover, directly to your revenue. Administration expenses should be more fixed costs that doesn't matter how much you sell, you've still got to incur those costs. And then you should be able to see a taxable figure towards the bottom. But again, we're going to see this in a lot more detail later on. The next one is a statement of financial position, or what most people probably have heard this for, is called your balance sheet. Now, the balance sheet to me is by far the most important statement within a set of financial accounts. What does this indicate? Well, the easiest way for me to explain what a balance sheet is to tell you that it's a snapshot of your company financial position at a specific point in time, your year end. It shows what the company owns, which are the assets, what it owes, so who the money's owed to, so that's its liabilities, and then what's called the owner's equity, which is the difference between assets and liabilities. So basically, if you were to sell everything you had and convert it all into cash and paid off all of your debts, how much money would you own? And that's what the owner's equity element going to be. So the assets are things that the company owns that have value. So the simplistic way to think of that is going to be the money that's in the bank account, right? That's the easiest way if it's positive. How much fixed assets it have. So how many assets it got to do the work that's going to be, computers, plant and machinery, cars, vehicles, those sort of things. And then finally, what inventory, that's the other key one that we see there a lot. So what stock have you got if you're selling goods and sales, so if you're actually selling items, what stock have you got to carry forward to the next year to hopefully sell within the next financial year? That is a real quick way of looking at what your assets are going to be. And then the other big one is any debtors you might have as well. So maybe how much money people owe you that you've not quite got the cash for yet, right? Then the liability is the opposite to that. So what do you owe people? So debts or obligation that the company needs to pay, loans, accounts payable, your creditors, those sort of things, credit cards, maybe your director's loan account, those sort of items are going to be there. And that basically means that if you were to sell up today, or if everything was going to be sold, you'd have what your asset figure is going to be, less those liabilities. That's what the owner equity, and that's basically the owner's share of the business. So you have those shareholders, how much is available to pay out to them when everything is sold up and all the debtors have been paid over. That's basically what the balance sheet. Now, the reason it's so important to us accountants is because it's our source of truth. As an accountant, one of our main jobs is to go through that balance sheet as at the year end, so whatever year end is going to be, and we have to basically have confidence that every figure within those balance sheets are correct. And we go through literally ticking those the individual account, making sure that we have confidence they're correct. Because basically the way that accounts work is it's all based on what's called debits and credits. And the really simplistic way that all you need to know about debits and credit is for every debit, there has to be a credit, and you have to balance that equation. And the way that it works with regards to balance sheet is basically if we can agree every balance on the balance sheet, then ultimately the accounts have to be correct. There may well be some presentation issues and it might not look as clean, but if your balance sheet's spot on, then the accounts themselves have to be correct because of that debit and credit criteria. So for us as the accountant, that's our most important thing. We need to be going through that balance sheet and trying to agree every figure that's on it. So let's understand a little bit of what this balance sheet is showing us. Because if you're signing the account, you're also agreeing that this balance sheet is correct. So at the very top here, and the clever thing is it has notes next to the majority of these numbers. So the idea is that this number here of £2,000, well, it's broken down by note 5. And the idea then here is that looking through here is tangible fixed assets. How much assets have I got? If I go to note 5, it's going to give me a bigger breakdown. What stock have I got? Last year I had £1,500 of stock. This year I've got 0 in stock. Basically are going to be items that I'm going to carry forward to next year that I haven't sold yet. Then we have debtors, how much money is owed to me as a business at this point in time. And again, I've broken down there. And a really key one, cash at bank in hand. At this point in time, we have £45 in our bank account at this year end. So obviously everything's going to be very, very tight at this point. They've got creditors figure, so how much we owe. And the idea then is you take your assets, you less your creditors, and the first thing you have is what's called your net current assets. And the idea of net current assets is the stuff that can quickly be generated into cash. So the idea that, debtors should hopefully be able to pay it up quite soon. Creditors should be able to done. So how much, once we've done that, do we have? And in this case, what negative figure? That's very important for me going forward, because that's how much money basically I would need to put into the company to be able to meet my short-term debtors and creditors, or in this case, creditors. And then we have what's called our net assets. And what we do with our net assets is basically we take it against our tangible fixed asset, the items that are still ours, but are going to take much longer to be able to turn into cash in most circumstances. That then gives me my net asset figure, negative at this point, which is a bad thing, to be honest. That means that the company itself is trading at a loss. If I was to sell up today, I'd actually be out of pocket. And then we have what's called our capital and reserves. Basically, it's going to be, how's that £171 split into? Well, £2,000 is against the share capital, so how much money was introduced at the very beginning. And then 371 is my profit and loss at this point in time. So if I was to sell this business today, wouldn't really be seeing a great level of return on it. In fact, I would have to, in theory, pay £171 into the bank to be able to clear and pay off all of my debtors, all my creditors that I have outstanding. Then we go into what's called our notes. So the first notes is all about general notes. It's going to give you addresses, principle of accounting. So what set of rules were used to be able to get these set of accounts together. And then there's various other ones. Now the ones that are going to be important to you are when we start getting into things like your tangible fixed assets. So from here, this is going to be broken down into different ones. And most of the time, I have more than this. But these are different categories of fixed assets. So items that you've got that are going to last more than 1 year, basically. So in this case, got £4,777 worth of plant and machinery. Then what happens with that plant and machinery is we spread it over the life. But when we spread it over the life, the cost of it, we call it depreciation. So the idea here is before this year, so brought forward, we had already accounted for £1,430. In this particular year, we're going to do another charge of £1,345, basically saying that we're putting £1,345 worth of our costs into this current year, meaning I've still got to go through and allocate £2,775 of this cost to the business or to the profit and loss account later in the following years. And that just gives you an idea of what this fixed asset register is supposed to do. The most key thing for you is this top figure. That's how much is your assets have. And then this bottom figure, the depreciation area, is basically how much of that we've allocated so far and how much we've still got to go, basically. The next one is a breakdown of our debtors. So this is going to be short term, how much money we are expected to come in. So trade debtors, that's how much money is owed to you. And in this case, unfortunately, we're in a bad position because we actually owe the company £3,052, which actually could cause us some really adverse consequences going forward. Other debtors to look out for that could be included in here, we have various things called prepayments, which are adjustments that we use at year end. The idea of this note here is that this 3,052 is what's on our main balance sheet and is broken down by these here. Creditors is the opposite to debtors. The idea here that trade creditors, how much money we owe to people. So at the moment, we've got quite an extensive amount of money that's owed to others. So we need to get our head around how we're going to get that paid. Corporation tax, so how much we owe to the taxman. And normally you'll have director's current accounts there as well, which is how much your director's loan account is at this point. We'll also notice as well that you'll have other taxes that owe into HMRC, VAT, PAYE will always fall under creditors, and it depends on how long there's left in the loans, but there's going to be loans that get put in the creditors area as well. Then we have what's called our share capital, so how many shares we have. In this, we've got a complex share structure, A and B's, 100 of A, 100 of B, and how much we're paid for those particular shares. And then finally, probably one of the most important bits is what's called your profit and loss account. The idea is you have what was brought forward, so £2,144 of loss come through, what profit we had in the year, so 4,273 in this case, and what dividends we were able to pay against that. Now, technically, we've actually paid too much dividends here, and we've actually left ourselves short. So realistically, in this scenario, we probably would class them as partly illegal dividends, which isn't a good thing. Then we have the director's loan statements and maybe controlling parties. So basically just notes to keep everything clean. Then to important parts now. So this is your detailed income statement. For me, this is the most important bit for you as the user, right? So you're going to have your turnover, how much money you've made in that period. And your period will tell you at the top here where it's going to go from. Then your cost of sales. What are those direct costs related to it? In this case, this is a cafe. So these are all the purchases that have been made. So in this case, it's purchases. So we would have to physically buy purchases, right? We'd have to buy goods for the cafe to then sell on. The idea of cost of sales is it should be in correlation to the sales you've made. In theory, purchases will only increase by the amount of sales we've had, and it'll have a correlation. The more sales we make, more purchase we need to make to be able to make that demand. And then we have what's called your gross profit. So you take your turnover, you less your cost of sales, and that's how much money you made based on those costs of sales. So those direct costs. What's happened? Like, how much have you actually made by selling those items in the first place? It's really useful to keep an eye on that, what's called gross profit percentage. Ideally, you want your gross profit percentage to be the same, if not better, than in previous years, because the better a gross profit, it means that the more profit you are making from those ghost items. So the more sales you make, the more actual money that, from a gross point of view, you'll be able to keep. And then we have what's called our administration expenses. And the idea, the difference between cost of sales and administration expenses is that admin expenses should be fixed costs, and it shouldn't really have any correlation between the sales. So in theory, you could keep selling and selling and selling and selling, and those admin costs should keep the same. Now, there's always a tipping point. You know, maybe you have to go from one rent cost to another because you've outgrown a warehouse or whatever it's going to be. But in reality, or in normal terms, it should be that those expenses, doesn't matter if you sell one item in a particular period or you sell 1,000,000 items in a particular period. In theory, those admin costs should then be associated against and should always be the same. And that gives you confidence then, and gives you an opportunity to build your business. A lot of businesses then have to create what's called the breaking point. And the breaking point should be where, how much gross profit do they need to clear? So how much sales do they need to get to that gross profit figure until they can clear all their administration expenses and start actually generating profits for the business going forward. Lots of things to keep an eye on here. One thing I would always recommend is look at it compared to the previous year. Is there anything that looks out of kilter? For here, why is my director's salary suddenly increased quite substantially from one year to next? Was there a change in director's salary? Was it a change in directors? Those sort of questions I've got to be asking myself. Rent and rates has almost doubled in this particular period. Why? What's going on? What should we be looking out for? Depreciation has increased as well. We don't have any sundry expense, any stationery, and any advertising. Is that correct? Should I be looking at my expenses a little more detail? Is there something missed? Or crucially, are there expenses I just didn't hand over to the accountant or didn't hand over to be accounted for? Those private expenses, you know, you're paying for your Canva account, for example, privately because you've put your credit card in and not the business card in. Those little things like that can soon mount up. So always try and look from one year to the next and see what's happening. And anytime there are big changes, just try and figure out and justify them. Why? What's happening? What's the reason for it? Finally, at the bottom here, UK corporation tax. Don't take that as gospel, but the idea here is a cumulative corporation tax. The idea from the accountant side of things is we're trying to account for all of the corporation tax changes that happened since day dot. So it could be the fact that there's differences, and there is other opportunities in there for like deferred tax and stuff like that. So yeah, keep an eye on that and have that as a kind of a bearing, but that won't be the full story for corporation tax. The next thing in our pack is our company tax return. To be completely honest with you, I wouldn't spend too much time on this one. Realistically, these are, boxes that have been completed for you. The accountant is being paid to make sure this is right. Just make sure things like addresses and the person signing and the date and stuff is correct. What I think is more important, and on this one I go all the way to page 25, the last 2 pages of my pack basically, is what's called your corporation tax calculation. From here, it's going to take the net profit figure, so 4,462. So I'm going to have some adjustments. So in my case, I've got some depreciation I need to account for, and then hopefully I might have some capital allowances to move over. Basically, that gives me a figure that I need to start figuring out what I need to do with. And in this case, £5,807. I actually have some trading losses in this case, 5,460. So basically, I want to look to utilize them. As I scroll down, you'll see that I've utilized my losses straight away. And that leaves me with a £347 profit to figure out. And then basically, once you've got profit there, it's going to apply whatever tax brackets that falls into, based on years, based on amounts, stuff like that. And then it's this figure here, tax outstanding. On mine, it's the second to last page that's there. That's the figure that I care about. That's how much I'll have to pay over to HMRC. And in my case, it's £66.49. Scrolling to my last page though, always worthwhile keeping an eye on this because this will be really useful planning going forward. Is what losses you had. So I had here, I brought 5,460. I've utilised 5,460, so I now have a total loss going forward of 0. But if you did have losses there, always useful, because that's going to be losses that you can utilise going forward. Basically, though, that's the end of the tour of the pack that's there. You use the information you've been given, have a look at it, and if you are happy with it, make sure you use the sign or reject option, your name, comment there, press the sign and confirm. If though you have any issues or questions on it, the best thing to do is go to the contact us area, and we use the bookings calendar here to book a meeting with us, and you'll notice there you'll be able to utilize the opportunity when you go to show more services to go to year-end accounts review. Then you can go find either pick a particular staff or pick a date that works for you and move on from there. So I've got Monday, Tuesday and Wednesday. Next couple of days, I've got loads of slots to pick out from, and pick a time that is right for you. There we have it. There is a breakdown of what you should be looking at when you get a set of accounts coming your way. Any questions, don't forget to use that opportunity to select staff and talk to them. At the end of the day, these are your accounts. We need to be making sure that you're happy with them before you press that sign button. But my name's been Patrick. If you've got any comments, use the comment section below. Anything you feel like I missed, anything in your accounts you don't feel like makes sense, and please use that comment section to let us know. Don't forget, like, subscribe, do all that sort of stuff. We've got real good growth on the channel at the moment. It's all thanks to you guys. So please, thank you so much for all your continued support. But if you can put a like, or even more importantly, a subscribe, then that would be brilliant to us. Thank you very much, and I'll see you in that video. Bye for now.